Sanjeevan sir, we are live.
Yes. Good evening, everyone, and welcome to the session organized by CP Committee of ICI on refunds in GST and overseas investment under FEMA. We have Chairman Purushottam Khandelwal sir of CP Committee. Welcome, sir. We have Sahil Gupta sir who will be speaking on refunds in GST and CA Vikas Vadra sir who will be speaking on overseas investment under FEMA. So welcome everyone for this session. Though everyone is busy, I hope this session will be a great interactive session and a lot of good input from both the speakers. Without spreading anything, I introduce today the chairman of CP committee, CA Purushottam Khandelwal sir. He is the chairman of CP committee and also convener of RBI Directorate of ICI. He's having 25 years of post-qualification experience in various fields of audit, direct and indirect taxation, and also intellectual property rights. This year, he has totally devoted himself for CP framework and guaranteeing quality across all the operational spectrum. And this year, major focus will be on upgrading the CP portal for enhancement and branding of and competency of all the members and professionals. So I welcome Purushottam sir and request him to give his opening remarks for the session.
Good evening, respected faculty, Shahil Gupta ji, Vikas Prata ji, moderator of this program and chairman of Nasik branch, Sanjeevan ji, secretary of the CP committee, and respected member. It gives immense pleasure to be amongst you on Wednesday. Every Wednesday, CP committee is organizing a webinar for members. Today is the last day of income tax return filing for individual, and the members are busy. But some of clients have habit to come on the last day, so they keep our member busy unnecessarily. I'm always of the opinion that we should plan work accordingly and finish within time or before time, so we can give our best services. Everybody knows that CP committee is the mother of all the committee. My committee is dedicated to organize national conference, half-day conference, residential refresher course, seminar, workshop for the subject of professional interest. I always said that what we are selling our services. So what is the cost of services will be depend on how you are upgraded. Today's faculty, Sahil Gupta is here to address you about the refund in GST. Every client loves money. When you bring refunds and give them, that is a value addition services to the client, because what you are giving them and taking back as a fee. You know that unnecessary held up referred by the department on various unnecessary hurdles. They are breaking a sequence of paying refund by one or any other currency, well. So today, faculty is here. My humble request you to address the members. Shahil Gupta ji, it's your session. Please take the session. Thank you so much. I will not take much of time because you all are here to listen the faculty. I am always available on the Wednesday. So members are more interested to listen the faculty. Thank you. Thank you so much.
Thank you, sir, for your kind and inspirational words. Now I welcome Sahil Gupta, sir, for the session. A short introduction of Sahil, sir. He's practicing in GST with more than 8 years of experience, also in service tax and VAT, and an in-depth knowledge of indirect taxation. He was a joint secretary of Tax Consultants Association, Ludhiana last year, and was also part of the editorial team of the newsletter committee of Direct Taxes Bar Association and Indirect Taxes Consultants Association, Ludhiana. He is an active speaker at seminars and corporate trainer for PSUs, MNCs, and other organizations, and was also part of the core team of professionals involved in writing the book Goods and service tax law, practice, and procedures. With this short introduction, I request Sahil sir to take over the session.
Thank you, Sanjeevan ji. Uh, good evening to all present and the dignitaries. First of all, I would like to thank Purushottam ji and Sanjeevan ji and all the CPA team to provide me the opportunity to speak on this platform. Uh, Actually, today the team has given me 45 minutes on this topic, but the topic is very much huge. So I will try my best to conclude within 45 minutes. So not much taking time. I will start the presentation. Uh, 1 second. Uh, Sanjeevan ji, is the
Yeah, yeah, the
visible?
screen is visible. Yeah.
Okay. So basically, what is refunds? If I start with the word refund is what we have paid in excess to the government. But how to identify that is excess? The government has provided various rules and regulations and conditions which we need to be followed. And if anything is excess, the government will pay us back. So there is some rules and regulations and the types of categories for which we can claim the refund. Starting with the categories of refunds, basically there are several types of refunds. If we see, mainly 95% of the criterias in refunds are covered in these categories. Other than these, there are 5% chances in exceptional cases that also government has provided us an option to file the refund under any other category. So starting with the refunds types, it is when we have paid the taxes to the government under zero rated supplies. In that category, what is zero rated supplies and nil rated supplies? Basically, generally the members or the assessees lag between what is zero rated supplies and what is nil rated supplies. Government has defined zero rated supplies, wherein they have mentioned that zero rated supplies are exports of goods or services or supplies of goods or services to SCZs. So SCZ units or SCZ developers. That is zero rated. And nil rated is against which the rate of tax is nil. So if we talk about zero rated supplies, it is not a 0% tax rate. They have the tax rate specific the product which in which we are dealing, that could be of 5%, 12%, 18%, or 28%. But due to the condition that they are supplied to foreign countries or to the SCZ units, that's why it is zero rated supplies. In that category, there are two types of refunds. First, if we supplied the goods to the foreign countries with payment of taxes, the taxes paid to the government against that supplies can be taken as refund. Otherwise, if we are paying without, if we are supplying the goods without payment of taxes, in that case, what we have purchased, the taxes on that inward supplies can be taken as unutilized ITC balance. So there are two types, like IGST paid on zero rated supplies in case of exports and SCZs. Thereafter, in unutilized ITC, that is the accumulated ITC refund that can be taken in exports or SCZs. In accumulated ITC, accumulated unutilized ITC case, there pertains one more category, that is inverted duty structure. Inverted duty structure means when the purchase rate of tax on the purchase is higher than the rate of tax on outward supplies. In that case, there is a difference in tax which we are paying on purchases and paying the government as a lesser rate. The difference government is allowing us as a refund. Thereafter, there comes the refund on under deemed export category. Deemed export is also defined by the government under notification 40 oblique 2018, 2017, wherein they have categorized four types of supplies as deemed exports. Number one, supply of goods by the registered person to exporter against advance authorization. Advance authorization is provided by the DGFT, wherein they are providing that advance authorization only to exporters who are exporting the goods. There is a format which a person has to apply to the DGFT to get the advance authorization. Against that advance authorization, the exporter can procure the goods from the registered persons domestically without payment of taxes. There are two types of refunds under deemed exports. First, supplier can take the refund of deemed exports, but to the exporter, if he supplies the goods to the exporter, the taxes paid by him can be taken as refund, or the recipient, that is the exporter, can claim the refund of what is purchased by him. Earlier, I was just discussing about the deemed export definition, 4 points. Number one, payment supply of goods to the exporter by the registered person under against advance authorization. Secondly, supply of capital goods by the registered person to the exporter against EPCG license scheme. Thirdly, supply of goods by the registered person to the EOUs, STPs, HTPs. Basically, export oriented units are also governed by deemed exports. If they are procuring the goods from the domestic area, in that case, they are also allowed as a deemed exporter and export the goods. The government has a policy: export the goods, not the taxes. In that criteria, he has divided exports, SEZs, deemed exporters in that criteria. Fourth criteria is uh, purchase of supply of gold to the PSUs by the persons. If a person is supplying to the gold to the PSUs, in that case also it is governed as deemed exports. Thereafter comes as the merchant export. Government in 2017 has provided a scheme that the goods can be procured from the domestic persons. If I am a trader, not a manufacturer, in that case, I can procure the goods at 0.1% of tax and supply the goods to the foreign country without under LUT, without payment of taxes. In that case, I can take the goods at 0.1% because initially when I am an exporter, I am procuring the goods from the market at 18% and then exporting the goods to the foreign country. My huge investment, that is working capital, gets blocked in that scenario, and the refund is coming at a later stage, say about 2 months, 3 months, and the initial phase, it's taking around 6 months. So the government came up with a scheme to procure the goods by the merchant exporters, basically the trader exporters, at 0.1% and supply the goods under LUT. In that case, their working capital will be very minimum. And this 0.1% has been levied only to check that what is procured from the industry and supplied as exporter. Earlier, there is a scheme in excise named as Roga Fraud, removal of goods at concessional rate of duty. The same scheme is similar, the merchant export scheme is similar to that scheme. Thereafter comes the specified organizations like embassies, UNOs, canteen store departments. They are named as specified organizations, and they basically they are not embassies and UNOs are not the Indian employees. They are working in India on behalf of the foreign countries. And if anything is supplied to these embassies or these employees of the foreign country, the amounts which the taxes which are levied and goods supplied to them needs to be refunded back. So all the inward supplies taken by embassies, UNOs are refunded back by the government if a form or a refund is application is filed by these embassies. They need to file the refund applications quarterly. Thereafter, canteen store departments, basically in the defense sector or military sector, there the government is providing that goods should be supplied to the persons, to the military persons or to the family members of that military persons at a concessional rate. In that case, if the taxes are levied to the canteen store departments or the retail store departments of these canteens, then the taxes will be borne by the consumer. If those taxes can be reduced, then the pricing of the goods will be reduced. That is why canteen store departments, central government has allowed that 50% of the CGST, basically the central taxes, 50% of the central taxes paid by canteen store departments on their inward supplies can be taken as refund. Thereafter, several other types of refunds are there. Foreign tourists, which they are coming to India and taking the goods out of India, they can take the refund at the uh, airports, custom stations, or any other custom station. Similar provisions are there in Singapore, Australia. Thereafter, excess payment of taxes or wrong payment of taxes. If I have paid any excess taxes or wrong payment of taxes, then that can be availed as refund. Balance in electronic cash ledger. I have deposited the excess amount in the cash ledger, which is not being utilized or used against any future tax liabilities, or there is any TDS or TCS deducted on my supplies by PSUs or government organizations, that gets credited into my electronic cash ledger, and the same can't be used in the future tax liabilities. That can be availed as refund. Thereafter, consequential refunds. Consequential means the refunds which we have to take as per the orders or direction of the appellate tribunal or any court. Like pre-deposits, I have done any pre-deposits against the appeal, that can be taken as consequential refund after the order of the appeal, if it is in the favor of the assessee. Then budgetary support system, like in northeast states, the government earlier has provided various types of budgetary support systems, like reduction in tax schemes, or like in income tax there are tax schemes like for 5 years no tax liability to be paid, or a small tax rate. Similar way in GST as well, the budgetary support system is there for that those northeast states. Thereafter, Seva Bhoj Yojana. Seva Bhoj Yojana is like gurdwaras and temples which are providing free foods to the as persons. In that case, the government has provided the scheme that the food and other utilities they have taken from the market on which they have paid the taxes, that can be taken as refund by them. Recently, in July 2024, government has provided a scheme wherein unregistered persons can also avail the refund. Basically, if I can say that if I have booked a building, a flat with the builder, and I have paid the advance amount as per the slab system, which is agreemented with, which has been documented as an agreement with him. After two stages, after two payments, two installments, the contract gets cancelled because of some dispute or any other reason. In that case, the taxes have been paid to the builder, but the time limit to issue credit notes, or the builder is not providing me the tax rebate to me. In that case, the unregistered person, me, who has paid the installments along with the tax, can avail the refund, being a person who has borne the taxes is required, can apply the refund to the government, and government has provided a functionality wherein unregistered person can take the non-assessee registration and apply the refund with all the list of documents required as per the circulars. We will discuss about the circulars in a later slab. Now, starting with the first topic, that IGST paid on zero rated supplies. First of all, I am taking IGST paid on zero rated supplies in case of export of goods. What is export? Export is what is taking goods out of India. If the goods are moving out of India, that is export. In case of services, there is a bifurcation. Export of services is defined therein, wherein 5 criteria is there. If that is fulfilled, then only it is export of services. But in case of export of goods, if we are taking goods out of India, that means it is export of goods. In GST, refunds can be claimed within 2 years from the relevant date. Relevant date is prescribed in each and every category. Different relevant dates are there for each category. Like in case of export of goods, relevant date is when the ship, in the case of sea, ship, or in the case of air, aircraft, or by land, that is the goods carrier, crosses the custom frontiers. In all the cases, when the custom frontier is crossed, in that case, that is a relevant date. But to check with the GSTN portal as well, we will link it with the GSTR1 and GSTR3B. Hope all are knowing about the what is GSTR1 and GSTR3B. I assume that. So in GSTR1 and GSTR3B are to be filed on monthly or quarterly basis. If we have to apply the refund, first of all, we have to file the GSTR1 and GSTR3B. If that is not filed, the refund can't be applied. So in that scenario, I will suggest that the 2 years will be counted from the date when the return is filed. Actually, 2 years are seen from the date the goods leave India, but due to the technical issues like GSTR1 and GSTR3B has to be filed. That means before filing of that, the time period has been started, but we can't apply the refund. So 2 years in this case also to be seen from the date we have filed the GSTR1 and GSTR3B, or the due date by which these 1 and 3B needs to be filed. In case of zero rated supplies, there is a with payment of taxes, there is a automated process of refund. The government, when we file the GSTR1 and GSTR3B, the details gets automatically transmitted to the custom portal, wherein the custom portal validates the details and then issues the sanction order, and the refund gets credited to the bank account through the PFMS system. This whole process, there are various errors which generally we members or the assessee does while filing the returns or shipping bills, due to which our refunds get stuck. So let us discuss about that. The fourth point I will discuss at a later stage. First of all, we are discussing about the criteria, how the pattern, how the refund gets automated in the case of export of goods with payment of taxes. First of all, exporter generates shipping bills, which on the custom portal, and custom portal IceGate provides a bill of lading. Thereafter, exporter with the help of invoice and shipping bill, all the details are mentioned in GSTR1 and taxes are paid in GSTR3B, which after validation by the GSTN sends to the custom portal. If there is any error at the time of validation by GSTN, the data doesn't get transmitted. We will discuss about the errors in the next slide. If there is no error in the GSTN validation, then the custom data will be transported to the custom portal. Thereafter, custom portal will validate the details with the shipping bills, and if the data is again processed, then the refund is sanctioned and provided to the exporter. If there is any mismatch on the custom portal, then that report will be generated and provided to the exporter on the IceGate portal. That can also be corrected. There are various types of errors like mismatch in shipping bill details, port details, or the amount details. Now, the mismatch criteria. Invoice number and date of invoice are not matching with the shipping bill details. Invoice value and IGST amount are not matching. Nature of export. If we are exporting the goods under LUT in GSTR1, but in shipping bill it is mentioned as with payment, or in GSTR1 we have mentioned as with payment, but on shipping bills we have mentioned it as LUT. Shipping bill number, shipping bill date, or port code are not mentioned. If these details are not mentioned, then the data will not be transmitted to the custom portal and refund will be pending. One-time amendment can be made in GSTR1. Major criteria due to which the data doesn't get transmitted is IGST paid in GSTR3B versus IGST payable in GSTR1. We file GSTR1 wherein details are mentioned, but in GSTR3B, we mention lesser amount as payable. or the details which needs to be mentioned in table 3.1b, that is under zero rated supplies, we mention it in any other column, 3.1a, 3.1c, or 3.1e. In that case, the data doesn't get transmitted because in GS 3b, GSTR 3.1b, there is no tax payment by us. In the initial periods, government has allowed that if the taxes have been paid in 3.1a or 3.1c or d or e, the consolidated figures will be taken by the government on the system for matching criteria, and the data will be transmitted to custom portal if aggregate amounts are paid in excess or exactly matches. Basically, if there is a difference of 100 rupees or more, the data doesn't transmit. If it is less than 100, then the data only transmitted to the custom portal. Common errors like shipping bill numbers, shipping bill dates, port codes are not mentioned. 3B, 3.1B, we have to mention in 3.1B, but we mention in 3.1A or C. These are the same we have discussed currently. This is the table GSTR 3B. 3.1A is of outward taxable supplies other than zero rated supplies. But B is for zero rated supplies. We doesn't mention in 3.1B, but mention in 3.1A, C, D, or E. Then the data shall not be transmitted. We have to mention the IGST export values in 3.1B. Similarly, in GSTR1, we have to mention the shipping bill details as well. If these are not mentioned, then refund will not be processed. Now coming back to the point number 4. Basically, due to the increase in refund values and there is forged document, on the basis of forged documents, government has provided a mechanism, strict mechanism through risk management centers. Basically, government has incorporated RMCC, risk management centers, wherein a detailed analysis will be done of the exporters, their suppliers, nature of goods they are exporting, and quantum of amounts they are exporting against the values of purchases they are making around. So all the artificial, on the basis of artificial intelligence, they are monitoring each and every transactions of the exporters. On the basis of those risk analysis parameters which they have defined, they are marking some of the exporters and their suppliers to be thoroughly checked by the jurisdiction officers. Earlier in the initial phase, say in 2019, when the mechanism was started, the government sending the details to the jurisdiction officer and withholding the refunds till the jurisdiction officer provides the report from reports on the basis of the supplier's verifications. If the supplier's verifications are corrected, only then the refund are sanctioned and the red flagging is done. If the supplier's verification is not sent by the jurisdiction officer, the refunds gets stuck and it is taking a huge time. Basically, any exporter, a person has several of the suppliers, and if the government is checking on the suppliers, that is first stage, second stage, third stage suppliers of that exporter, in that case, one or two suppliers will be under the risky category. And due to that, 5 to 6 months or 1 year time lapse, the funds of the exporters are getting stuck. And government, on the pressure of the exporters, the government has decided to ease that and ease that functionality and reduce the time period, but with a strict mechanism. So in 2022, government issued a clarification and a new mechanism wherein custom shall issue the refund applications in case of risky exporters to the jurisdictional officer, wherein the applications will be reflected on the GSTN portal, done applied by the custom authorities and passed by the jurisdiction officer within that 60 days period. In section 54, there is a period, 60 days is defined, that the refund application needs to be sanctioned or rejected within 60 days time frame. We will discuss about that time frame and the procedure of the refund application and how to file that refund application in a later slides. So due to this application, this functionality, which gets the issued by the government in October 2022, but the implementation of that has been started from February 2023. Many of the exporters have got the refunds. More than 90% of the exporters have got the refund due to this functionality within 60 days, which is a very welcome step by the government. And the verifications are done speedily in that case, because earlier, if see, if the exporter gets verification of the suppliers as well, still the procedure is very lengthy, because first of all, RMCC sends the details to the DGRM. DGRM then sends to the jurisdiction officer. Jurisdiction officer, after verification, provides the report to the DGRM, and DGRM provides that report to the RMCC, and then RMCC sends the details and clearance to the custom authorities, after which the refund is processed. Now, the refund is processed by jurisdiction officer within 60 days of the application applied by the custom authorities. And thereafter, the refund gets credited within a few days after the sanction. Advisory for future refund claims are that shipping bills, details, and invoices are to be punched carefully. EGM and bill of lading should be done by the shipping companies correctly. And while filing 3B1, we need to take care of the details which we are filing and in which columns we are filing. One major thing that I need to tell, that there is also a manual refund processing mechanism is also there in the customs. If any refund application gets stuck due to any reason, which we are unable to rectify, like there is any error in shipping bill details, which can't be rectified now. In that case, we can visit the shipping custom authorities like duty drawback section or some designated refund cell in the custom authorities, wherein we will provide that rectified details to the custom officer, to the respective officer, who will then do that corrections on the custom portal IceGate, which will be sent to the DG system for verification. And after that verification, if that is corrected, then temporary scroll and permanent scroll will be generated and refund will be provided. Through this mechanism, the old pending refunds under customs due to any technical issues can be resolved. So if any person is having refunds which is get stuck on custom and he is not having any solution about that, then he can reach out to that custom officer. He will guide it properly. Recently in 2024, government has provided with a scheme in from the very long. The exporters are also having one more issue, that when they have exported the goods or services, thereafter the price is revised. Like some debit note has to be issued, some extra goods sent in, or they are receiving some additional funds because of that price revision. In that case, the taxes, they have to pay the taxes on the additional upward revision, but the shipping bills can't be amended because the time for shipping bill amendment has been lapsed or some other reason. So that amounts which the IGST which they are paying to the government get stuck, and they are not getting that refund on continuous basis. So government has come up with a scheme that in case of upward revision in price of goods subsequent to exports, the exporters can file the refund on the on the GSTN portal. They have provided the functionality in that, along with the supporting documents like supplementary invoice, debit note, additional amount received, FIRC copy, and agreement through which that upward revision has been done. And in this amount can be taken within 60 days as well. Same procedure, that is RFD 01 has to be applied along with the supporting documents, and the jurisdiction officer has to sanction the upward revision IGST paid along with that GSTR 1 and GSTR 3B. But here in one condition is one criteria also comes if there is an upward revision, there could be a downward revision as well. If there is any downward revision, in that case, government has through this circular has specified that the person, if there is any downward revision, then the person has to refund back the proportionate refund along with interest to the government. Now question arises that earlier we have paid the taxes to the government against this supply, again for which we have received the refund. So if we have paid through the electronic credit ledger, what about that credit ledger? Because we are paying back the refund. What about the cash ledger? Again, if we have paid through cash ledger, in that case as well, firstly we have to pay to the government as per this circular, along with interest, and then that electronic credit ledger or cash ledger can be recredited by the officer on request through PMT 03 or 303A. In case of export of services, till now we have discussed about export of goods. Now I am going to talk about export of services. Export of services, government has provided a definition of export of services wherein 5 conditions are mentioned. If all the 5 conditions are completed, only then it will be treated as export of services. Firstly, the supplier of service is located in India. Recipient should be outside India. Place of supply in the case of export of services is the outside India. Fourthly, payment should have been received in convertible foreign currency or in INR if prescribed by RBI, or through special vostro account in the corresponding bank of the foreign country. If fifthly, the fifth condition is that the supplier and recipient should not be the mere establishments of the distinct entity. If all these 5 conditions are fulfilled, then only it will be treated as export of services. In export of services, there is no automated refund process. An application has to be filed on the GSTN portal, which will be verified and checked, and after verification, the refund will be sanctioned by the jurisdictional officer. Application in GST RFD 01 is to be filed along with the supporting documents. In export of services, relevant date will be within 2 years from there is 2 criteria basically. Similar criteria are defined in the formula in 89.4, wherein turnover of services, export of services will be calculated in this criteria only, where the supply is completed prior to receipt of payment. If supply is completed prior to receipt of payment, date of receipt of payment is in convertible foreign exchange or in Indian rupees wherever permitted by RBI. In case supply is completed, but supply is completed before, that is invoice has already been issued before the receipt of payment. In that case, receipt of payment. In case payment has been received in advance, but invoice is issued at a later stage, in that case, invoice. So the criteria is whichever is later, date of receipt or date of issuance of invoice. In case of export of services, when we talk about the calculation for 89.4 as well, export of services, there is a crux. We have to take the turnover as well as per the relevant date. That is receipt or invoicing, whichever is later, will be treated in the current month. If we are talking about July month, if I am applying the refund of July, in actual, I have exported the supplies of services of around 1 crore, but the invoicing against which payment has been received in advance in the earlier months is 50 lakhs, and the invoicing and the payments against which invoices has been done in earlier months is 40 lakhs. then the 50 lakhs plus 40 lakhs, that is 90 lakhs, is my export turnover of services for the purpose of refund. Because as per the relevant date, my turnover for this month is only 90 lakhs. These are the forms under which the whole procedure of refund is mentioned. We will discuss it in the next slide. Here I have prepared a procedure wherein all the before mentioned forms are covered. An application in RFD 01 has to be filed by the assessee within 2 years from the relevant date. Proper officer will scrutinize it within 15 days. If he thinks that the application is complete, then he will issue the acknowledgement in RFD 02. If he thinks that the application is lacking for some documents or details, then he can issue the deficiency memo in form GST RFD 03. So 01 is the application form, 02 is acknowledgement, 03 is deficiency memo. In case deficiency memo is issued, then again we have to file a refund application in RFD 01 correcting the deficiency. The similar process will go on till the time the refund application gets acknowledged in RFD 02. Earlier, the period we have 2 years time period for applying the refund. If we doesn't apply within 2 years, then the application gets time barred. So earlier, if I am applying the refund application on the last date or second last date of time barring position, that is when the 2 years are getting completed. In that case, after 10 days or 15 days, if the officer issues a deficiency memo, then my application will get time barred. Even I apply the refund application again on the same day. So this is the technical issue due to which the applications of the assessee are getting time barred without any error of that assessee. If any documents are lapsing, then the officer can ask for that from the assessee without time barring its application. But due to this technical issue that the application has to be made on the portal and within the 2 years time frame, that application is getting time barred. The government has come up with a condition that if a person has applied the application and he is getting the deficiency memo, the period from the date of application of refund till the date of deficiency memo will not be part of the counting of 2 years. So if I am applying on the second last date, then after 15 days, I am getting the deficiency memo, and on the same day or after on the next day, I am applying the refund application, then that will not be time barred, because in that case also it shall be treated as second last date of the if on the date which is on which deficiency memo is issued, the date will be treated as second last day. After the issuance of acknowledgement in RFD 02, the officer can issue sanction order directly or can issue the show cause notice. The show cause notice will be issued in RFD 08. After that show cause notice, I have to reply within 15 days in RFD 09. If after the reply, the officer will sanction the refund order will issue the sanction order within 60 days or reject the refund. And the sanction order is RFD 06. After the issuance of sanction order, it has to issue a payment advice in RFD 05 through which the amount sanctioned will be credited to my bank account. So we have covered RFD 01 application form, 02 acknowledgement, 03 deficiency memo, 06 sanction order, 05 payment advice, 08 show cause notice, RFD 09 is reply to show cause notice, and 04 is provisional refund sanction order, wherein we will discuss in a later stage where the officer can issue 90% of the refund claimed amount through that RFD 04. 07. RFD 07 is the form wherein if complete adjustment of the refund sanctioned is done by the officer against any earlier demand. In that case, the officer will issue order of adjustment in RFD 07 instead of 06 and 05. Refund rejection order will be issued in 06 itself. In case refund is not sanctioned within 60 days, the officer, the government is liable to pay us the interest at the rate of 6% or 9%. 9% in case if any consequential refund is allowed to us, that is against the appeal order, we have to receive the refund, and the officer doesn't issues the or sanctions the refund within 60 days. In that case, interest will be paid to us at the rate of 9%. Now there are 2 to 3 points which we have not forms which we have not covered. Government have also provided us a functionality to withdraw the refund applications. Suppose we have applied the refund application, and in that application there is some error or some issue is there which we need to rectify, or the refund application was filed mistakenly. In that case, government has allowed us the refund withdrawal option. Refund application withdrawal can be done till the time no show cause notice has been issued, that is 08. RFD 08 has not been done, or sanction order has not been issued, or provisional refund order has not been issued, or order for complete adjustment has not been issued. Means after the acknowledgement, before any further working by the department, we can withdraw our application. That form is called RFD 01W. RFD 10 is a form wherein embassies, UNOs, they can apply the refund application. That application has to be filed on quarterly basis. Similarly, RFD 10A is a form wherein canteen store departments can apply the refund application, and form 10B is defined for duty-free shops. They can apply the refund. GST RFD 11 is letter of undertaking, wherein we are supplying the goods out of India or services without payment of taxes. For that, we have to take letter of undertaking, LUT. It is a 2 minutes process to file this application. If any amount is deducted, that amount needs to be recredited to the electronic cash ledger or credit ledger. If it is deducted while filing at the time of refund from that ledger, that recredit needs to be done through PMT 03. If any refund has been taken, excess refund was taken, and we identified that this is wrong refund, and we reverse that amount to the government. In that case as well, we have to take the recredit of the earlier debited amount while applying the refund from the electronic credit ledger. That recredit will be done by the officer through PMT 03A, because the refund has been sanctioned in complete to the assessee in the initial stage. Now I am left with very less time. I am taking up a small work. I am going to discuss the issues on a smaller note only. Basically, supplies to SEZ units and developers. These are taken at par with exports. Similar provisions apply here as well, but the SEZ supplies are covered by development commissioners. So a mechanism has been provided by government wherein all the goods supplied to SEZ units or developers for only authorized operations, a list has been provided by the development commissioner. wherein authorized operations has been mentioned, like nature of services for which SEZ units or developers can take the inward supplies, or the type of goods which they can take, or any permissions they have taken to procure type of goods by the SEZ units or developers. If that authorized operations, if the supply has been made for that authorized operations only, then it is refundable. Otherwise, no refund will be allowed, and taxes will be applicable in that case if it is not done for the authorized operations. And similar provisions, like we have discussed in the earlier uh, uh, slides, will be applied here. Provisional refund, I have discussed that 90% of the provisional refund will be allowed within 7 days. And the further calculations or sanction procedures will be done by the officer at a later stage. But to reduce the working capital pressure on the exporters, the government has allowed that the refund of 90% of the applied amount will be provided to the exporter if the conditions are fulfilled. Like he is not guilty of 250 lakhs of amounts, or his credit rating as per the GST portal is good. Although the officer can sanction complete refund, that RFD 06 and 05 within 7 days as well. But if it is taking time, then within 7 days, it has to issue 90% of the refund claimed amount. Later on, the set amount, if there is any difference, like we have applied for 90, we have applied for 1 crore of refund, and in 7 days, it has provided me 90 lakhs. After the verification, the refund amount goes to 80 lakhs, and the sanction order is issued for 80 lakhs. In that case, the officer is allowed to recover that amount, the differential amount, along with interest from me through DRC 07, that the show cause notice and proceedings, or I can itself pay the amount through DRC 03 on a voluntary basis along with interest. Now comes the accumulated ITC refund. We have discussed that accumulated ITC refund of unutilized ITC as per section 54 clause 3 can be availed in 3 categories: when there is we are exporting the goods out of India or exporting the services, when we are supplying the goods or services to SEZ units or developers for authorized operations, or if there is any inverted tax structure. Any amount which is availed as refund from the unutilized ITC that gets debited from the electronic credit ledger. Government has prescribed a formula in Rule 89.4 for supply to SEZs or exports. In 89.5, it has provided the formula how we can claim the refund in Rule 89.5. Maximum refund is calculated through Rule 89.4 or Rule 89.5, but the refund eligible to us, that has to be seen in from the out of the lower of the 3 criteria. Maximum refund as per the formula, lower amount of electronic credit ledger available as on the date of applying the refund. Thirdly, amount of unutilized ITC balance of electronic credit ledger as on the date for which the refund is filed. Basically, for the period for which the refund is filed, at the end of that period, which amount is, what is the amount of electronic credit ledger? All the 3 amounts will be compared in totality, not the headwise ICS. No, we have to check it in a consolidated basis, and the total amount will be seen, and the lower amount of the 3 will be refunded back to us. We will discuss the pattern, how that amount should be applied on the GST portal in the next slide. Refund of unutilized ITC will be filed in a chronological manner only. Like we have to file the previous month's refunds first, then we can apply the further periods. Like first of all, we have to file for July 17 to March 18, then April 18 to March 19. This is the criteria. there is no concept of annual refund application. We can apply for 4 years, 5 years as well. But for that, we have to check that the application must not get time barred, because we can apply only for the 2 years. Later on, we will discuss on the COVID relaxation as well. Time limit, which has been increased by the COVID notifications. In case of unutilized ITC, the relevant date is the due date of GSTR 3B on monthly basis. If we are filing quarterly basis, then we have to check it on quarterly basis. 2 years will be counted from the due date of GSTR 3B. Here, formula has been prescribed. I am leaving this point because I am running short with the time. Actually, one more session is there after my session. Turnover of zero-rated supply of services I have discussed earlier in the first slide. Now, I have discussed that which balance can be claimed as refund. Maximum amount that can be claimed as per Rule 89, or balance in the electronic credit ledger at the time of filing of refund claim. Third, balance in the electronic credit ledger at the end of the relevant period. Lower amount of these three balances will be taken. But while filing the refund application, lower amount has been taken. Thereafter, what amount should be deducted? Firstly, we have to deduct, like example, if we take the example that I am applying the refund of 50 lakhs and the minimum of the three is 50 lakhs, but as on date, I am having IGST balance of 20 lakhs, CGST 50 lakhs and SGST 20 lakhs. In that criteria, first of all, we will utilize the complete IGST balance of 20 lakhs. Thereafter, equally divide from the CGST and SGST 2020, and the remaining amount. Basically, the 50 lakhs is the refund application amount. So 20 lakhs is IGST balance, and then 15 and 15 lakhs will be equally divided into C and S. If the refund application is 70 lakhs, in that case, CGST will be 2020 plus 10 lakhs in CGST, the remaining balance. I will be sharing the slide with the team. If they think they can share with the members who are joined. I have provided the examples and all the relevant provisions in this slide. So they can you can go through those slides as well in the earlier stage. So now I'm going to cover the major topic, major points. Those are the relevant points which I think I have to discuss with you guys. Like jurisdiction of application. If I have applied the refund application and that application is not showing on the GSTN portal that it has been delivered, first of all, it will be intimated to the jurisdiction officer, whether it is center or state. If the jurisdiction officer has not been assigned to us, then the earlier jurisdiction officer to which we pertain will be processing a refund application. And if the application has been sent to the wrong jurisdiction officer, he can allot our application to the correct officer within 3 working days. Further, government has provided that if he is not able to allocate that application to the correct officer, then he is the correct officer to sanction that refund application or reject that application. He can proceed with the sanctioning procedure. Recredit of ITC, I have discussed that PMT 03 or 03A. Withdrawal of application, I have discussed. Now, I will discuss about blackout period. Basically, during the COVID, the government has provided a notification wherein they have stated that 2 years period will not be counted for refund time barring provision. That is from 1st March of 2020 to 28 February 2022. Basically, from March 2020, starting from the March 2020 till February 2022, this 2 year period will not be counted for the calculation of 2 years period. Recently, I have came across some issues wherein professionals or like advocates or CAs are saying that 2 years time frame has been increased for all the refund applications. Even that period is going on continuously till now. But I have to say that if the 2 years period, that is 1st March 2020 to 28th February 2022, needs to be eliminated, and then only 2 years period will be counted. For example, if we calculate the refund time period for 2 years for April 2020, the time period till February 2022 shall not be included. After that, from 1 March 2022, 2 years will be counted. For May 2020 as well, from the time barring provision for calculation of 2 years will be started from 1 March 2022. Similar is the provision for all the refund applications till February 2022, till January 2022. For February 2022, the starting date will be 21st March 2022. Before that, January 2022, we have to count the 2 years from 1 March 2022, and the time barring provision will be on 28th or 29th February 2024. So, for the applications from April, March 2020 to January 2022, time barring comes on 29th of February 2024. Members are getting wrong conclusion that the refund applications are getting increased by 2 plus 2. But only the COVID relaxation period, that is 2 years, 1 March 2020 to 28th February 2022, will be eliminated for calculation of 2 years. Deficiency memo, I have discussed. Recently, government has added a functional a clause wherein earlier, if I am not getting in case of export of goods or services, I am not receiving the foreign convertible currency within a time frame given by FEMA or RBI. In that case, I have to refund back the amounts taken by me as a refund along with interest. Later on, if I am getting back, I am receiving the foreign convertible currency, say after 2 years or 3 years, then the government has provided the functionality wherein I can claim the refund, that is, which I have paid to the government due to that non-receipt of foreign convertible currency. That refund application has to be made under excess payment of taxes, along with the proofs that I have received that payments and a CA certificate wherein it is mentioned by the CA that I have paid I have received this sum against the old invoices against which I have reversed the refund amount. Deemed exports, I have discussed. There is two criteria. Supplier of deemed exports can also avail the refund application, can also avail the refund, or the recipient of deemed exports on the basis of 1:1 receipt, inward supplies, can avail the refund. Merchant exports is 0.1% supplies. In this case, the merchant exporter has to export the goods under LUT, and the person supplying to the merchant exporter can apply the refund under inverted duty structure, as it has procured the goods on 18% or 28% or 5 or 12% rate, but supplying the goods to the merchant exporter at 0.1%. So there is a condition, the condition was fulfilled that he is procuring the goods at higher rate and supplying the goods at lower rate due to this criteria. Specified organizations, UNOs, embassies, I have discussed. They can also apply the refund within 2 years, but they have to file the refund on quarterly basis. Foreign tourists, we have discussed. Electronic cash ledger balance, a person can apply the amount in its electronic cash ledger as a refund. All the applications needs to be filed in RFD 01A. In case of change in place of supply, if I have paid the IGST amount and but I have to pay CGST and SGST, in that case, I can pay the CGST, SGST now and avail the refund of IGST paid earlier. The 2 years time period will be calculated when I will pay the correct head tax. Interest will not be levied in this case. Consequential refunds is against the order of the court, and 2 years will be counted from the date of the receipt of order. Refund by unregistered person, I have discussed earlier. In this case, that builder example I have given, that refund can be availed by me as an unregistered person. I have to register myself as non-assessee base, and then I can apply along with all the supporting documents mentioned in the given notification and circular. This is the checklist of documents as per Master Circular 125 and after that amendments. If any person is applying the refund, he must check Master Circular 125. That is the main circular wherein all the earlier requirements and the checklist of documents which is mandatory is provided, which is being changed after that date, but a little bit of changes are there only. Not all the formats are changed. I have tried to compile here all the list of documents required, which can be checked at a later stage. So this is all with my submissions of this topic on GST. Shreji, if there is any queries, Sanjeevan ji.
Sir, there are one or two questions. I'll just
Hope I have not taken much time.
no, it's fine. Can inverter refund application be revised, which has already been approved and sanctioned and disbursed? And is there any time period and process for that?
Sir, basically, for this query, I want to answer in two concepts. Firstly, if the application has been applied and approved, sanctioned, and the payment has been received by me, that cannot be rectified. But revision is possible by the officer. Revision of order is possible within 3 months.
Okay.
The office, we can apply for the revision of order, or the officer itself can revise that order. If the order is against us, then we can go for that appeal as well. The first is we cannot rectify the order because the order is sanctioned, or the application cannot be withdrawn. Because if I have applied the refund, if there is any error, we are having the option to withdraw that application and again apply that. No chronological order is applicable in that case as well. If I have applied for April, May refund, thereafter I applied June month, but I got information that April and May is incorrectly applied. So I can withdraw April, May refund application and again apply that. And June application will sustain accordingly. So revision possibility is there, but revision has to be applied online within 3 months, or similar provision is there within 3 months we can apply for the as an appeal.
Okay.
The revision, sir, one thing more, revision can be extended again for 3 months, but that is with the permission of commissioner.
A separate application has to be done for that.
Yes, basically 3 months is available with the jurisdiction officer. If that has to be increased to 6 months, that needs to be done by the commissioner only.
So one more question. where the order is placed by foreign customer on us and asked us to supply goods to SEZ in India. Can it be termed as export for GST?
If an order has been placed by the foreign customer and
And
goods have been
asked us to
supplied to
supply those
SEZ
goods to
units.
SEZ in India.
Okay. Sir,
Uh,
basically, place of supply, good, in this case, goods have not been crossed the Indian borders, firstly. But secondly, we have supplied to SEZ units. SEZ units are governed by the custom authorities, covered by development commissioner, but are come under the custom parameters. So that is also not uh, stated as Indian territories. So if we supply it to the SCZ as well, then it can be treated as exports or zero, basically not exports, it is zero rated supplies. So we can take the refund of that. But officer, we have to deal with the officer and justify him that this is zero rated supplies.
yeah. Okay, so there are only few questions. Thank you very much for a enlightening session. I hope all the audience, it's a big topic which cannot be discussed in 45 minutes.
Sir,
We
I have
hope further
tried
that
my
we will
best.
again have you for further discussion and further sessions. Thank you. Thank
No
you very
worries.
much,
Thank you,
sir.
sir. Thank you, Sanjeevan ji, and the whole CPEC committee and our vice chairman, sir. And Chairman Sir for providing me this opportunity. I thank all the members to listening me and making this session interactive by asking questions. Basically, from the start, I am thinking that I am the only one speaking. At the last, when some questions are coming, then I can say that someone is listening to me.
So there are almost more than 200 participants.
Okay, that would be a good number, sir.
Yeah. So I'll be sharing the site with all the participants who are sending questions to share the slides. The slides will be shared with everyone after the session is over by the CPE committee. So thank you, Sahil sir. Thank you very
Okay,
much.
thank you, sir.
Moving on to the second session, we have Vikas Quatra sir with us, who will be taking session on overseas investment under FEMA. I welcome Vikas sir. Vikas sir was here listening to the first session. Welcome, sir. Just a brief introduction of Vikas, sir. He's a qualified forensic auditor and also certified anti-money laundering and law specialist conducted by the Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICI. He is serving as a part of Executive Committee of Ludhiana branch of ICI and was the chairman of Ludhiana branch for the period 22-23. He has delivered multiple sessions on FEMA and GST across various platforms. So the combined GST and FEMA session, we have an expert who is also working under GST and also under FEMA. So welcome Vikas sir, welcome to the session. And we have almost got to 5:15, so I request you to please take over the session from here.
Thank you so much, Sanjeevan ji, for the brief introduction of mine. And special thanks to the chairman of the CPE committee, Purushottam Lal ji, and to the vice chairman, CA Gyan Chandra, for giving me the opportunity to deliberate on this session. And most interestingly, on 31st of July, and by your words that I have heard that right now 200 participants are already there listening to this webinar, and that's a great number for the ICI on this date also. So let's move forward, and without taking much of the time, shall I share the screen?
Yeah.
Is it visible?
No, not yet. Yeah, it's visible now.
So it's visible now.
Yeah, it's visible.
Okay, thank you, Sanjeevan ji. Moving forward, our today's session is on overseas investment under FEMA, and before moving forward to the slides, let me introduce to the today's topic, overseas investment. By overseas investment, we mean whenever we undertake any transactions related to making any investment outside India in terms of equity or in terms of debt, or it's a hybrid mode, or while taking purchasing of the property, then we have to make a compliance with the overseas investment regime, which is newly launched in the year 2022, after the erstwhile regime of the overseas direct investment was vanished and decided by the central government. So investing outside India can be a complex process due to various legal and regulatory frameworks. So this presentation provides an overview of the overall framework for making investments outside India. What are the brief about the FEMA? Before moving forward, I will give you the brief introduction about the FEMA. So it is a 49 section act, out of which only 9 sections are substantive and rest are the procedural or administrative. So first 9 sections are the most relevant sections of the FEMA, which overall undertake the global view of the transactions which we have to undertake in the foreign currency, or while undertaking the uh, transactions in terms of the foreign currency. What is the regulatory framework of the FEMA? It complies of FEMA Act, rules, FDI policy, notifications, circulars, master directions, and regulations, most probably. So whenever we have to undertake a transaction, first we have to make us define that what is the nature of the transactions. So basically there is 2 types of transactions, that is capital versus current account transactions. Once we can understand which kind of transaction we are going to undertake or we are going to propose to undertake, then we have to move forward to see what kind of regulations we have to look after for undertaking the proposed transactions. So what is the capital account transactions? Pardon? This one, just a second, sir. Just a second, sir. It's okay now? Okay. Thank. So what is the capital account transactions? As a layman, we can understand the capital account transactions, which is capitalized in the books of accounts, or current account transactions, which are the span of which is within a year, but not at in the FEMA. The view is totally different. The capital account transactions means a transaction which alters the assets or liabilities, including contingent liabilities, outside India of a person resident in India, or assets or liabilities in India of person resident outside India, and includes transactions referred to in subsection 3 of section 6. For your kind information, the section 6 subsection 3 is right now rescinded by the government, but definition of capital account transaction is not right now amended by the central government. So we have to mention it because it is the part of the definition. What is the current account transactions? Means a transaction other than a capital account transaction and without prejudice to the generality of the foregoing. Such transaction includes payment due in connection with the foreign trade, other current business services, and short-term banking and credit facilities in the ordinary course of business, payment due as interest on loans and as interest as net income from investments, remittance for living expenses of parents, spouse, and children residing abroad, expenses in connection with the foreign travel, education, and medical care of parents, spouse, and children. From this view, just a second. Okay. Moving forward, the current account transaction, we can see the 4 limbs of the current account. Sir, there is some mistake with the Zoom. I can't correct it. Okay. So first 2 limbs are payment for the business purpose, that is payment due in connection with the foreign trade, or the current business, etc. And secondly, with the interest on loss and or interest income from the investments. And second two limbs are of the personal nature, that is remittance for the living expenses or expenses in connection with the foreign travel, education, and medical care of parents, spouse, and children. So, what is the new overseas investment regime? What was the erstwhile law, and what is the new regime which came into force on 22nd of August on 2022? Erstwhile, the regulations which were binding on the transactions when we have to undertake the foreign investment transactions. These the regulations were Foreign Exchange Management Transfer or Issue of any Foreign Security Regulation 2004, and there was also Master Direction of Investment by Residents in the Joint Venture and Wholly Subsidiary Abroad. But after 22nd of August, a new regime was introduced and was launched in the Gazette of India, and the new investment regime comprises of the three administrating administrating documents, which are the Overseas Investment Rules 2022, governed by the central government, and Overseas Investment Regulation 2022, administered by the RBI, and Overseas Investment Directions issued by the RBI. Uh, uh, so a new concept has been bought, and the earlier concept has been vanished due to some reasons. There was not a liberalization, rationalization, and there was lack of clarity in the civil regime. And government has tried to bring clarity and liberalization to the new regime. And some newly introduced definitions are introduced, some of which we are right now understanding, trying to take the overview. The definition of control. Control means the right to appoint majority of the directors or to control management or policy decisions exercisable by a person or persons acting individually or in concert, directly or indirectly, including by virtue of their shareholding or management rights or shareholders agreement or voting agreement that entitle them to 10% or more of the voting rights or in any other manner in the entity. Definition of control, why it is relevant, because overseas direct investments can be determined because of the control, whether we have the control in the foreign entity or not. It is basically we can make an understanding of that with this definition only. Secondly, determining eligibility to invest in debt instruments or lend to or provide guarantee to or on behalf of the foreign entity of the subsidiaries. And thirdly, for identifying subsidiary and step down subsidiary of the foreign entity. So control, basically, we can understand the control. This is a chart. I will share the PPT later on with the team that will provide it to you. On what is foreign entity. Earlier, there was a concept of wholly owned subsidiary and joint venture, but right now it has been replaced and a new concept has been brought. That is the foreign entity. Foreign entity means an entity formed or registered or incorporated outside India, including international financial service center that has limited liability. So focus can be made on the limited liability concept. So by this, we can understand that the proprietorship concerns and the partnership concerns which have unlimited liabilities are not considered as a foreign entity. And similarly, we can't make any investment in the entities which has limited liability, provided that the restriction of limited liability shall not apply to an entity with the core activity in a strategic sector. Accordingly, investments outside India in a sole proprietorship or general partnership where liability is unlimited is not permitted at all. What is Indian entity? Indian entity, a company defined under the Companies Act. Four limbs are there of the Indian entity. A company defined under the Indian Company Act. A body corporate incorporated by any law for the buying in force, like ICA, it is incorporated by a law. A LLP, partnership duly formed and incorporated under the LLP Act. A partnership firm registered under the Indian Partnership Act. So unregistered partnership firms are not considered as an Indian entity. Only the registered one are considered as the Indian entity as per the FEMA overseas investment regime. What is the overseas direct investment, or ODI. ODI, as you can hear, that it is a common word used in the terms of the investment when it is made outside India. But a lot of clarity was there. Lot of ambiguous clarity was there when we have used the terms in the banking forms. So, what is the ODI? Overseas direct investments, or ODI, means investment by way of acquisition of unlisted equity capital of a foreign entity, or subscription as a part of the memorandum of association of a foreign entity, or investment in 10% or more of the paid up capital equity of a listed foreign entity, or investment with control where investment is less than the 10% of the paid up equity capital of a listed foreign entity. So here the control definition is relevant as we have discussed earlier. So what is ODI? ODI is basically in the equity capital, subscription, and acquisition of the unlisted equity capital, or a subscription of the part of the memorandum of the association of a foreign entity. So we can make an understanding that ODI, first of all, it is in the equity capital, and whenever it is done in the unlisted companies, then always the investment will be considered as an ODI. And secondly, subscription as a part of the memorandum of association of a foreign entity. And when it comes to the case of the listed foreign entity, then it will be considered, the investment will be considered as a ODI if it will be 10% or more, or less than 10% with control. So in case of listed entities, if we have made an investment which comprises of 10% or more of the equity capital, then even without control, it will be categorized as an ODI. And when there is a control, then irrelevant of the fact that how much is the percentage of the holding of the equity capital, it will also be always be categorized as an overseas direct investment. And for the purpose of disclose, where an investment by a person resident in India in the equity capital of a foreign entity is classified as an ODI, such investment shall continue to be treated as an ODI. Let's suppose we have made an investment where we have made an investment in the equity capital of a listed foreign entity with the equity capital of 11%, and later on in a year, the capital we have reduced the percentage of the capital from 11% to the new 9%. Then in that case also, it will be considered as an ODI. So once an ODI is always an ODI, so all the compliances with regard to ODI have to be made later on also. What is overseas investment? Overseas investment means financial commitment and overseas portfolio investment made by a person resident in India. We will elaborate this concept in the later on slides. So moving forward, what is overseas portfolio investment? Overseas portfolio investment means investment other than ODI in foreign securities, but not in any unlisted debt instruments or any foreign security or any security issued by a person resident in India who is not in an IFSC. So OPI means other than ODI in a foreign security, but not in any unlisted debt instruments. So by this we can make a overall view of the ODI and OPI. OPI is other than the ODI in the foreign securities, but not in an unlisted. So unlisted, every time we have make an investment, equity investment in unlisted entities, it will also always be considered as an ODI. Okay. Provided that OPI by a person resident in India in the equity capital of a listed entity, even after its delisting, shall continue to be treated as OPI. So once an OPI is always an OPI. What is the concept of subsidiary or step down subsidiary of a foreign entity? SDS of a foreign entity means an entity in which the foreign entity has a control. Subsidiary is defined to mean an entity in which the foreign entity have control, and control by control we mean the definition we have read earlier. And the structure of such subsidiary SDS shall comply with the structure requirements of a foreign entity, that is, such SDS shall have limited liability where the foreign entity's core activity is not in a strategic sector. The investee entities of the foreign entity where such foreign entity does not have control shall not be treated as SDS and therefore need not to be reported. So what is the here is the example of an Indian entity and the foreign entity. Indian entity, foreign entity, XYZ company is a foreign entity and holds a control in XYZ. Here XYZ is to be considered as a subsidiary of foreign entity. Coming to the second example, XYZ company, here it is a foreign company, a foreign entity, does not hold control in XYZ. So under the new regime, here XYZ will not be considered as a subsidiary of the foreign entity because the holding entity, that is XYZ company, is not having a control in holding entity is not having a control in the subsidiary of its. What is the financial commitment? It means an aggregate amount of the investment made by a person resident in India by way of overseas direct investment, debt other than the OPI in a foreign entity or entities in which the overseas investment is made, and shall include the non-fund based facilities extended by such person to or on behalf of such foreign entity or entities. So financial commitment is a summation of the ODI, debt plus non-fund based facilities extended by the Indian person resident in India to or on behalf of foreign entities. And when we make a summation of the financial commitment plus OPI, it comes out to be a overseas investment. What was the what will happen to the erstwhile investment which was made in accordance with the regime which was active before 22nd of August 2022. So there is a concept of grandfathering provisions. Grandfathering refers to a provision in law or policy that allows individuals or entities to continue with their existing practices or privileges despite the implementation of new regulation. This is usually done to provide protection or a grace period of those who have already made investments or taken certain actions based on the previous regulations. The erstwhile regulations will have a active mode in the current regime also, provided that they are in compliance with the erstwhile regime. Let's suppose some investments were made which were in compliance with the erstwhile regime but are non-compliance with the present regime. Then also that type of transactions are legal in terms of the FEMA. Any structure which is not in compliance with the new regime but was in compliance with the old regime can continue without any further approval. However, the structure which were not done in compliance with in earlier regulation but are in compliance with the new regime, new OI regime, does not become the compliance structure automatically. So in case there is a lack of compliance with the transactions which were made earlier before the new regime, then there is a two types of options available under the FEMA. That is either file for the compounding, which is somehow a complex procedure, or a new concept has been brought in overseas regime. That is a concept of late submission fees. And so the reporting requirements in that case can be make good by submitting the late submission fees, and there is separate regulation for this, and there is separate methodology for calculating the late submission fees. There is also an opportunity given to the to regularize filing lapses by paying the applicable late submission fees within the 3 years from the reporting due date, without having to undergo the compounding process. Besides the future reporting delays, the LSF facility has also been extending to the delays in reporting under the erstwhile regime for 3 years from the date of notification of OI rules and regulations, that is 22nd of August 2022. So what are the eligible entities to make the overseas investment? So these are the entities which can make the overseas investment, and so we can go forward. It's a resident individual, registered trust or society, mutual funds, venture capital funds or alternative investment funds, clearing corporations of stock exchange and clearing members, domestic depository and banks, Indian entity, that is company, body corporates, LLP registered and partnership registered. Any other entity like association of person, etc., are not allowed to make investments outside India. Under the old regime, there was a concept of the Indian Party, where all the investments from India were together considered as an IP, Indian Party. But it has been substituted under the new regime with the concept of the Indian entity, where each investor shall be separately considered as an Indian entity. Similarly, the concept of joint venture and wholly owned subsidiaries replaced with the concept of the foreign entity. So, what are the preconditions for making the overseas investments? The overseas investment can be made in the bona fide business activity only. What is meant by the bona fide business activity? Any activity permissible, which is permissible by the law enforced in the host jurisdiction and the uh, India also. So any business activity permissible under any law enforced in India and the host country or the host jurisdiction, as the case may be, is considered as a bona fide business activity. So every time we have to take care of the fact that the investment in the foreign entity must be done in that only that sector which are working in a bona fide business activity. So any unlawful activity in India or in foreign entity is not allowed. What There are also some jurisdictional restrictions. Overseas investment outside India can be made in any country in general, but there are some jurisdictional restrictions. However, the central government has the power to notify the jurisdictions in which the investment cannot be made or may be made with the prior approval of the central government or the RBI, as the case may. Right now, jurisdiction restriction is only on the Pakistan. So right now, the government has notified only Pakistan as a pre as a country in which we have to undertake the overseas investment only before taking the prior approval of the central government. What are the rules of making the overseas investment? A person resident in India may make or transfer any investment or financial commitment outside India under the automatic or approval route, subject to the provisions contained in the new overseas investment regime. What is meant by the automatic route or the approval route? It is as under automatic route by the, as a name defines, it is it is a route that requires no prior approval and to be obtained before making such an investment. And in case of approval route, means prior approval of the RBI or the central government should be taken before making the proposed investment. So what are the routes? What are the transactions which are covered under automatic routes? Are the transaction if the overseas investment is within the prescribed limits. Right now, the limits are 400% of the net worth in case of the Indian entity, and limit specified under the LRS in case of resident individuals, that is right now 250,000 USD. And if it doesn't fall in the sectors or the jurisdictions which need prior approval of the central government or the RBI, then the investment will be categorized under the automatic. And what are the transactions which require the prior approval of the central government? It is the case of when the OI is made in the country of Pakistan or any other jurisdiction, as the case may be advised by the central government, or when the overseas investment is undertaking in the strategic sectors, that is energy and natural resources and the startups. When approval from the RBI is required, when the financial commitment by an Indian entity exceeding 1 billion USD or its equivalent in a financial year, irrespective of the fact whether it is within the overall limit of the 400% of the net worth, when a transaction amount is exceeding or is equivalent to the 1 billion USD, then we have to take up approval of the RBI, irrespective of the fact whether the overall transaction is within the limit of 400% of the net worth. And whenever the financial commitment exceeds the 400% of the net worth in case of ODI, a prior approval of the RBI must be taken, and 50% in case of OPI, prior approval of the RBI must before undertaking such transactions. What is the pricing guideline under the new OI regime? As per the Rule 16, issue or transfer of equity capital of a foreign entity can be undertaken in the following forms. Transfer can be made by the person resident outside India to the person resident in India, or it can be by the person resident in India to the person resident outside India, or it can be person resident in India to another person resident in India. Whenever the transaction is taken, pricing guidelines must be followed by the uh, Indian entity while undertaking such transactions. What is the basis of the pricing guidelines? It is the basis of the guidelines that it must be on the arm's length as per the internationally accepted pricing methodology, which is made in sync with the NDI rules. Now, the concept of arm's length was not there in the erstwhile regime. It is a wholly new concept brought in the new overseas investment regime. Earlier, the concept was that the pricing must be supported by the professionals undertaking like the CA or the CPO or the merchant banker. But right now, no such categorization has been made. No such professionals are quoted by the overseas investment regime. So it is left upon the AD bank who shall make the board policies to approve the pricing guidelines. So as per the internationally accepted pricing methodology, there are three methods of making the valuations. The first one is the asset-based valuation, and by asset-based valuation, we can understand what is the value of the or total assets in the balance sheet. And earning-based valuation. Earning-based valuation is based on the future cash flows, taking into consideration the growth factor of the companies. And third one is the market-based valuation. It is based upon the similar business activities which are undertaking in the host jurisdiction of the foreign entities. Who can do valuation? In the old regulation, it was specified that the merchant banker, chartered accountant, CPA could do the valuation. However, this has not been restored in the new rules. Nothing have been specified in the new OI regime with regard to the who can do the valuation. AD banks have been left to make their own board policies, board approved policies, and valuation must be as per the internationally accepted pricing methodology. No particular type of professional specified valuation have been quoted under the new overseas investment regime. By this, moving forward, newly concept has been brought of the deferred consideration to make the overseas investment more rationalized. A deferred consideration is a portion of the purchase price that is payable by the buyer in the future rather than at the time of disposal. Earlier, deferred consideration was not allowed, and a new concept has been brought. And deferred consideration is allowed only in the following cases: when a person resident in India acquires capital by way of subscription to an issuer, or by way of purchase from the person resident outside India, and person resident outside India acquires equity capital by way of purchase from the person resident in India, and such equity capital is reckoned as a overseas direct investment. So deferred consideration is only in the case of ODI, not in the case of OPI. So what are the preconditions for deferred consideration? The foreign securities equivalent to the amount of the total consideration shall be transferred or issued upfront by the seller to the buyer. So by this, we can make an understanding that the equity capital must be transferred at the time of initial amount which will be transferred. So the full consideration finally paid shall be compliant with the pricing guidelines as discussed earlier. That is the internationally accepted pricing methodology. The deferred part of consideration in case of equity capital or foreign entity by a person resident in India shall be treated as a non-fund based commitment. And the last one, the condition is very important. The period of deferment have to be definite period from the date of the agreement. So there must be an underlying agreement before taking a transaction which is covered under the deferred consideration. So here is an example of this methodology of deferred consideration. You can make an understanding of this example with the slide that will be shared later on. What are the restrictions and the prohibitions in the overseas investment regimes? What kind of transaction we can't undertake, or in which kind of businesses we can't make an investment, or which kind of business will require prior approval of central government or the RBI, as the case must be. Unless otherwise is provided in the Act or the rules, no person resident in India shall make ODI in foreign entity engaged in real estate activity or gambling in any form or dealing with financial products linked to the Indian rupee without specific approval of the RBI. What is the real estate activity? Real estate activity means buying and selling of real estate or trading in the TDRs, but does not include the development of township, construction of residential or commercial premises, road or bridges, or selling or leasing. So whosoever foreign entities engaged in the real estate activity that is dealing in property dealing, or with the motive of or with the motive of only property dealing, that is buying and selling, in that foreign entity you can't make any overseas investment. The restriction with regard to the investment in startups, the term startup has not been defined anywhere in the act or in the regulation or in the rules. Any ODA in startups shall not be made out of the fund borrowed from the others. A certificate in this regard from the statutory auditor or chartered accountant of the Indian entity investor is required to be obtained. Furthermore, the startup is included in the definition of the strategic sector. The restriction of limited liability will not be applicable in case of the investment in the foreign entity which is considered as a startup as per the host jurisdiction. Accordingly, ODI can be made in startups in unincorporated entities as well. Two layers of subsidiaries. The two layers of subsidiary need to be considered from the perspective of Indian party or the foreign entity. This can be inferred from the direction as well as from the form FC. What is meant by the two layers of subsidiary? Meaning of two layers of subsidiaries as per the OI direction 2022 is subsidiary shall have the meaning as provided in the OI rules, that is an entity in which the foreign entity has a control. What is meant by the two layer? What will be considered as a layer? So whether the Indian entity will be considered as a first party or this foreign entity will be considered as the first layer, while making the understanding of the layers of the subsidiaries. It is specified in the form FC that the level of step down subsidiary shall be calculated treating the foreign entity as the parent. So an SDS directly under the direct FE foreign entity should be considered as the first level SDS. Accordingly, as step down subsidiary under the first level SDS would be treated as second level SDS, so on and so forth. So what is overseas investment right now? An overview of the overseas investment is that financial commitment plus OPI is equal to foreign investment. And what is financial commitment? Financial commitment is the ODI plus non-fund facilities. Non-fund facilities by non-fund facilities we mean to undertake the guarantees issued by the Indian entities on behalf of the foreign entities is covered under the concept of non-fund entities. And thirdly, the debt. So ODI, non-fund facilities, and the debt are the summation of the foreign financial commitment, and financial commitment plus OPI is considered as the overseas investment. So ODI means, what is meant by the ODI? ODI, as discussed earlier also, it is by way of acquisition of unlisted equity capital of a foreign entity. All investments in unlisted equity entity or unlisted entity shall be considered as ODI always. Secondly, subscription as a part of the memorandum of association of a foreign entity, it will be always be considered as an ODI. Or investment in 10% or more of the paid up capital, equity capital of a listed entity, and or investment with control where the investment is less than the 10% of the paid up equity capital of the listed foreign entity, then in these cases the investment will be considered as an ODI. Once an ODI will always be an ODI. What is the precondition? One of the precondition is that the investment should be made, and what is the there is a concept that every time investment is made, a mind thought is always there that some amount will be transferred outside India, but no, it is all not always there. Capital contribution by way of remittance is not a prerequisite. For example, let's suppose you got an equity capital by way of gift, then in such cases also ODI is applicable, and we have to make a reporting accordingly to the RBI. So capital contribution by way of remittance is not a prerequisite of making an overseas investment. What is overseas portfolio investment? OPI is other than the ODI in the foreign securities, but not in any unlisted debt instruments or any securities issued by a person resident in India who is not in an IFSC. Overseas portfolio was not defined till 22nd of August 2022. So it was not defined in the as well as regime. So there was lot of confusion with regard to the overseas portfolio investment and reporting of the same. Since OPI is an overseas investment which is other than the ODI, OPI, it cannot be in any unlisted entity. OPI by a person resident in India in the equity capital of a listed entity, even after its delisting, shall continue to be treated as an OPI. What is the foreign security? Foreign security means a security in the form of shares, stocks, bonds, debentures, or any other instruments denominated in foreign currency and includes securities expressed in the foreign currency. OPI is allowed to be done in listed debt instruments. What is listed debt instruments? It is defined in the overseas investment rules. It is government bonds, corporate bonds, all tranches of the securitization structure which are not equity tranche, borrowing by the firms through loans, depository receipts, whose underlying securities are debt securities. What are the limits of the OPI investments? OPI investments shall not exceed the 50% of the net worth of the Indian entity as on the date of its last audited balance sheet. And in case of a resident individual, the limit is as per the LRS, which is right now 2,50,000 USD. What is the significance of differentiating a transaction between the ODI and the OPI? Both are regulated differently. They are separate reporting requirements for the ODI and the OPI, and moreover for the OPI reporting is required now. The reporting is required for the OPI also, but resident individuals who are undertaking the OPI as per the ILRS are not required to file the form OPI. Instead, they have to go through the LRS form, that is A2, and disclose there with the purpose code of making an investment as an OPI. It is very essential that the nature of overseas investment is established before undertaking the overseas investment. It should be checked for the restrictions, and accordingly, transaction should be undertaken. So investment outside India, in case it is in listed entity and where it is less than 10% without control, it will be considered as an OPI. And in case less than 10% with control, it will be a ODI. And in case it is 10% or more, it will also always be considered as an ODI. And in case of unlisted entity, it is always be considered as an ODI. So what are the limits? Limits of overseas investment are as under ODI plus debt plus non-fund based facility. It must be within the overall capping of 400% of the net worth of the Indian entity, and in case of OPI, it is the 50% of the net worth. The limit is over and above the financial commitment limit of 400%. So one can take the first three limbs, that is ODI, debt, and non-fund-based facilities within the overall capping of the 400%, and separately can take on overseas portfolio investment, that is 50% of the net worth. The overall limit of investment of the ODI route plus the OPI route shall not exceed the limits specified under the LRS. What is the net worth? Net worth is as defined under the Companies Act, and for the purpose of the net worth of the LLP and the registered partnership, it shall be the sum total of the capital contribution of the partners and undistributed profits of the partners after deducting there from the aggregate value of the accumulated losses, deferred expenditure, and the miscellaneous expenditures not written off as per the last audited balance sheet. Calculation of the net worth. These are the points. It's the summation of the paid up share capital reserves out of the profits minus accumulated losses, deferred expenditures, and miscellaneous expenditures not written off. What is the role and responsibility of the AD banks? No particularly list of documents has been prescribed by the RBI or the central government to the AD bank to be taken from the parties who are taking the foreign transactions for making the overseas investment. It is all dependent upon, it is all left upon the AD banks to prescribe their own policies of listing the prescribed documents while taking the foreign transactions. purpose compilation of the balance of the payment statistics as per the IMF and other policy making decisions by the RBI, and are also used for the other macroeconomic management purposes. All the data is gathered, and such transactions are reported in the online portal which is provided by the RBI to the AD Bank. The portal name is FETERS, Foreign Exchange Transaction Electronic Reporting System. So it is basically that the data which is we have to submit to the AD Bank at the time of undertaking the overseas investment. It is further reported by the AD Bank to the RBI via this portal, that is FETERS. What is the responsibility placed on the AD banks? AD banks are the hands of the RBI for implementing the policies. AD banks must take care of the transactions at the. They must take the self undertaking by the transacting party, certification by the independent professionals, declaration by the authorized person, and then moving forward these data to the RBI is the prerequisite and the responsibility placed on the AD banks by the RBI. So AD banks need to ensure that the transaction is the bona fide transactions, and it is in compliance with the extant FEMA provisions, and compliance with the KYC guidelines, compliance with the anti-money laundering guidelines and the laws. Any doubtful or suspicious transaction shall be referred to the Department of Enforcement for further investigation and necessary action. So this was the overall introduction of the new overseas investment regime, which has come into the force in the year 2022. The slide will be available to the CPE team, which are coordinating with me for the members who are listening to this session. So thank you so much for this to the CPE committee for organizing this session, and a special thanks to the Purushottam ji, the chairman of the committee.
Thank you, sir. So just I will check whether there are any questions.
Yeah, sure.
Hello.
Ji?
Screen close. So there's a question that I am an NRE. I am MD and holding 99% shares of private limited company with paid up capital of 2 crore. Can I bring 10 crore as non-repatriation loan to the company without approval?
Sir, can you repeat the question?
Yeah, the person is an NRE and an MD and in a private limited company with holding 99% shares with paid up capital of 2 crores.
Okay.
Can the person bring 10 crore as repatriation loan to the company without approval?
Repatriation loan, what to the to whom it have want to repatriate the loan, to the Indian entity or to the foreign entity?
To the it's not mentioned. I think it is an Indian entity to where the loan has to be brought.
It is a concept of the FDI.
Yeah.
It is a ODI plus FDI concept, and it has to look from the FDI perspective also. So there need to be a detailed discussion of the FDN for clarifying this query.
Okay. So one more question. Capital invested into consulting establishment incorporated overseas in a free zone. Would this be considered as ODI? And if so, is there a threshold to obtain formal approval and from which authority?
Approval is required only in the case where the limit has exceeded of the 400% of the net worth, and we before taking this transaction, reporting requirements must be fulfilled. That is, you have to file the form FC with the AD bank, and moreover, annual compliances with regard to reporting requirements such as APR and FLA need to be filed every year.
Okay.
But no prior approval is required if it is in the overall capping of the 400% of the net worth of the Indian entity or the resident individual, as the case may be. In case of resident individual, it must be within the overall requirement of the LRS, that is 2,50,000 USD right now.
Okay. So the previous question, He has posted a new question. He's following from the earlier question. If I am a resident but not ordinary resident, and if the capital contribution is made from account maintained overseas, does it require approval?
What is the sources of the funds in the overseas account? It is a detailed discussion. So I have to make
Okay, okay,
forward the more questions that what is the sources of the funds lying in the overseas accounts. If it is
okay.
earned in the overseas, in the host jurisdiction from the legitimate business, that is like one is working in the Australia and they have earned salary over there, and they want to make investment from that salary, then there is no permission required from the RBI, and no restriction is placed on such transactions. And moreover, there is no restriction of the overall investment capping, that is 400% of the net worth.
Uh, so one last question. What is the tax implication for ESPP and RSU shares
uh,
issued by foreign parent
so,
company to Indian employee?
Pardon, the Sanjeevanji, we are discussing on the FEMA
Yeah, sir, we are
perspective
discussing
policy.
on the
So it is
FEMA
a
part.
it is
We will
a
have to leave apart the taxation part.
it is totally a different concept, and we have to take care
Uh,
of the income tax perspective for this.
for the anyone, the slides will be shared. We have number of Vikas ji in that and also his email ID. You can connect with him later regarding any specific queries or any consultancy you will be requiring. So thank you, Vikas ji, for the session.
Thank you, sir.
I hope it was a short time, but I hope the matter has been focus has been cleared upon most of the facets of FEMA. So thank you very much for delivering the session, and I hope all the participants have gained much from both the sessions. Thank you, Chairman of CP Committee Khandelwal sir and Vice Chairman Gyanchan Mishra sir for this all Wednesday sessions, CP session. All the participants really get a breakthrough information from all the sessions. Thank you everyone, and thank you all the CP committee for organizing the same. Shreya, you can take over from here. Required. Yes, yes.